The stock market, a dynamic force that reacts to news, trends, and policy decisions. But how much power does a president wield over it? Can they truly crash it? The president is often seen as a driver of economic stability or instability. Their words, decisions, and even tweets can influence investor confidence. Stock markets thrive on certainty. When that is shaken, whether by unexpected policies, controversial statements, or international diplomacy, the ripples are felt across the market. Consider the market crash of 1987, Black Monday.
It's going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
I don't think anyone really expected a bank as big as Lehman to be in a position that it's in now.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
I'm starting to find another job.
Meanwhile, Merrill Lynch, fearing it could be next, agreed in an act of desperation to a shotgun marriage with Bank of America. Merrill, the country's biggest brokerage with 60,000 employees, had been battered by nearly $50 billion in mortgage-related losses.
It is definitely a very, very difficult time, and it's not going to get better quickly.
So in just 6 months, 3 of the 5 biggest independent firms on Wall Street have now disappeared. Bear Stearns, which collapsed last spring, Lehman Brothers, and Merrill Lynch. Treasury Secretary Henry Paulson tried to reassure investors today.
The American people can remain confident in the soundness and the resilience of our financial system.
Paulson attempted to broker a deal to sell Lehman over the weekend, but unlike the buyout deal for Bear Stearns, the government would not offer any financial guarantees.
I never once considered that it was appropriate to put taxpayer money on the line in resolving Lehman Brothers.
It would have required an $85 billion subsidy to keep afloat. Overall, I estimate it's going to cost at least $400 billion if you wanted to bail out the whole bunch. They're certainly not worth it. It's better to let them fail.
While no single president was responsible, market analysts linked it partially to fiscal uncertainty. Or take 2018, when trade wars caused massive drops. Investors reacted to fear of tariffs and global economic shifts.
By placing tariffs on foreign imports of steel and aluminum.
A president's decisions on taxes, trade agreements, or corporate regulations can directly impact industries and stock valuations. For example, a corporate tax hike might send certain stocks plummeting, while deregulation could spur growth. Even a geopolitical misstep can set the market reeling, sparking sell-offs globally. But let's not forget, presidential power has its limits. Economic policies require congressional approval. Global markets, consumer behavior, and corporate earnings also play a huge role. The stock market doesn't answer solely to one individual, even if that individual resides in the White House. So can a president crash the stock market? Not alone, and not unless he has a sledgehammer. In the end, the market is a complex web. A president is just one thread in the tapestry. Drop your thoughts in the comments below. Your voice matters. If you enjoyed this video, like it, share it, and subscribe so you don't miss what's coming next. And don't forget to check out the videos at the end. They're ones you won't want to miss.